Let's take a look at Ethereum's layer 2s could take revenue from the blockchain as they become more competitive. Now, we talked about this a little bit. It's still kind of hazy, trying to figure it out, but layer 2s and their roll-ups could be something that miners could provide proofs for that would generate revenue for people that are currently mining, just in a different manner on the Ethereum blockchain. This could be extremely relevant from a profitability and revenue perspective for miners, so keep a close eye on it. On the 18th, we have, like I said, an interview coming out with the senior researcher for ZK rollups, or one of the ZK rollups, and I think that's going to be really important and relevant for you guys to check into. So the Ethereum blockchain needs layer 2 systems to help deal with its shortcomings on cost and throughput, though those same scaling products could leech revenue from the network as they become competitive rather than complementary, crypto exchange Coinbase said in a research report. It's feasible that layer 2s could become the application layers hosting the bulk of the economic activity, while Ethereum exists exclusively to store transactional data. And I think to a certain extent, this is the way you want it to function. We've talked about this before, the difference between layer 1s, layer 2s, and layer 3s, and the need for all three. And I don't think that this is a negative. Outside of the fact that it could be a negative for the holders of Ethereum specifically. And so it'll be interesting to see how the Ethereum devs and the Ethereum Foundation respond to this type of information. But I think they're already pretty aware of it, right? And I think a lot of it comes down to the lack of Ethereum's ability to actually implement a scaling solution, as they have pretty much just gone away with the idea of sharding at this point in time for Ethereum 2.0, to the point of basically rebranding Ethereum 2.0 to something completely different that doesn't exist anymore. So as a layer 1 network is the base layer, or the underlying infrastructure of blockchain. Layer 2 refers to a set of off-chain systems or separate blockchains built on top of layer 1s. A decentralized application is a digital app that uses blockchain technology to keep users' data out of the hands of organizations behind it. The future of layer 2s could be a zero-sum game, because the layer 2 that houses the majority of dApps could power the entirety of the Ethereum ecosystem, the report said. There is about $68.9 billion in total value locked on Ethereum, compared with the $5.2 billion across layer 2s, the report said. While the total value locked in layer 2s is relatively small, the implementation of zero-knowledge Ethereum virtual machines, ZK EVMs, is looking more achievable and could lead to major traction in layer 2 growth, the note said. Coinbase says that if more user activity moves to layer 2s and those blockchains need their own tokens to enable transactions, that could reduce the staking yields to Ethereum validators, cutting their revenue. And of course that's going to happen, because essentially if you were staking in Ethereum, you were expecting some sort of sharding and layer 1 scalability that's not happening. So this is inevitable at the end of the day. What is interesting from the mining perspective is that we may have the ability to generate revenue via ZK proofs. That could reduce staking on the platform and increase the amount of ether circulating, potentially damaging the cryptocurrency's price. Or worse, which is really what we have to get into, reducing the staking on the platform directly will reduce the security of the layer 1. And what's most important in layer 1? The most important thing in layer 1 is security. And everything Ethereum is doing right now with the merge and the move to proof of stake is reducing the amount of security on their layer 1. And this is a problem, because as far as layer 2s go, they could run whether or not Ethereum was proof of work or proof of stake. And so this is a bad decision on Ethereum's part. If you're going to do away with layer 1 scaling when you move to, of course, proof of stake, you should just go away and do away with proof of stake. But they can't do it. They're in a pickle. They've been promising it for so long that if they don't do it now, it's going to completely collapse Ethereum. So either way, it's a danged if you do, danged if you don't situation. For the time being, transacting on Ethereum's main network will provide a solution for users who need or value security over speed, the report said, noting that losses on cross-chain bridge exploits have reached $2 billion this year. More activity accumulating to an application on layer 2 would reduce congestion and fees on layer 1, and that could result in better price discovery for ETH, the note said. So they're also thinking that it could increase it. But Ethereum's crashing transaction fees are a symptom of a lack of demand of users as users await the merge. So people are not participating within Ethereum right now as much because they are essentially awaiting the merge. So it's kind of a hodl situation. They aren't utilizing it. But this also does beg the question, where do you get to when you get into a position where the entire incentive structure is built around staking, right? And you get to that and then you stop the transactional throughput because it's not becoming a usable chain as much as it is becoming a store of value, right? And this is like the classic like Bitcoin versus Dogecoin argument, just with a single chain sort of, right? So relative to its year-to-date low of $880, Ethereum is now up around 100%, spurred by a broad-based recovery in the risky asset universe, as well as the investor euphoria around the upcoming merge event. As illustrated in the chart above, Ethereum is currently trying to turn a critical price level into a support. Should this endeavor prove to be a success, the world's second largest cryptocurrency by market capitalization can then attempt to wrestle with the next major resistance around 2200 to 2460 price level. As a refresher, Ethereum is slated to transition to proof-of-stake transaction authentication framework with the upcoming merge event, which will see Ethereum mainnet become a shard on the Ethereum 2.0's beacon chain. Sort of. We're just going to have two layers, right? Consensus layer and execution layer. Under a proof-of-stake transaction authentication mechanism, validators are given the opportunity to authenticate blockchain transactions based on the amount of Ether coins that have been locked or staked in dedicated nodes. In contrast, under proof-of-work framework, as is with the case of Bitcoin, miners win the right to authenticate transactions based on the amount of energy expended to perform the complex computations. Ethereum is now set to undergo its last major merge test before the merge event. Should the Goerli test conclude without a major hiccup this week, it would pave the way for Ethereum to smoothly transition to a proof-of-stake framework. Nonetheless, all the excitement around the merge event is currently manifesting itself in a weird anomaly. To wit, the 7-day moving average of Ethereum's transaction fees is currently at the lowest level in at least a year as measured by the block. The anomaly can be explained by a lack of demand from Ethereum users as the mainnet prepares to join the beacon chain, heralding a dramatic reduction in the network's energy consumption. And just look at the 7-day average of Ethereum's adjusted on-chain volume, which is approaching 2020 activity levels. Readers should note that the merge will not resolve Ethereum's high transaction fee issue. The issue will be tackled via the sharding initiative that is slated to go live in 2023. No, it will not. You're behind. It is slated to be tackled by ZK rollups and completely different entities. Sorry, WCCF Tech, you're a little behind as far as what's going on. So make sure you guys are aware that this is not actually true, okay? We're going to actually have to completely skip all of this because they're talking about sharding, and sharding is not really true right now. So we'll just skip that. And actually probably just skip the rest of the article, unfortunately, because I do not think that we're going to get anything good out of it, because that is a huge oversight by WCCF Tech and their team. Thanks for checking out this clip from the Crypto Mining Show. You can check out the full episode here or more crypto content down here. Also, I'd like you to check out my locals page at sonofatech.locals.com, where you can become a member for free or choose to be a $5 a month supporter that unlocks additional content.